Right, like I said, this relief, this rollover relief, is very much restricted to business use ultimately, and so when we see a scenario where there is no business use, because all these reliefs we've been talking about are very much for people running businesses, and they will take advantage of this. We need to make sure we exclude the non-business element, and then this is what this question sort of highlights. So if you look at this, it says here that they purchased a factory on the 1st of November and sold it on the 1st of November 18, and he sold it for 1.45 million. And he purchased the factory for 300,000. The factory was used throughout the whole, except for the period the 1st of June, 1st of January 6 to the 31st of December 7. So over this 2-year period, this asset was not in business, was not used for the purposes of his trade. So in effect, that gives us a 2-year period here, and therefore a 14-year period for the rest. So what can he therefore roll over, so to speak? So we first of all find the gain. So it says that we have here that he sold the thing for 1.45 million, and it cost 0.3 million, therefore giving us a gain of 1.15 million. And what we now have to, if you like, therefore do is to separate out purely the business element. And the business element, if you like, is 14 over 16, which is 14 years out of 16 years, times 1.15 million, which gives us 1.006, or one. I'll just go back to simple numbers because this isn't coming out of my calculator very well. 1006 250. So that's the business element. That's the gain, if you like, as far as the business element is concerned. So it says that he spends 1.4 million, if you like, on another factory, which he uses 100% for business purposes, and that's fine. So what he can clearly do quite easily is to, yes, roll over in that 1.4 million, he can roll over the 1006 250. He can roll over that that gain, if you like, into that and defer that, reducing the base cost to 393 750. And that's kind of how we deal with that. The non-business element, as you can imagine, is this 2-year period was not business related, so it can't enjoy any of the sort of, it's just a chargeable asset as normal. So whatever that was, we would do basically whatever the balance is of this, the difference here. So 2 over 16 times 1.15, which will give us a nice clear 143 750. All of this is a straightforward chargeable gain that is not business related, so cannot enjoy any business relief or any of those things. And that's how we kind of deal with that. So it's about making sure, but again, like I say, with practice, you start to pick up these things on the business element and watching out for it. Right. Now, this next bit of the video looks at this idea of depreciating assets. Here's a problem. As you can imagine, all the assets we've been talking about appreciate. So we know, right, that in their process of appreciation, they will keep that gain within the body of the asset, and at some point we will truly realize that gain, right? Because you have the gain that's come from the old asset plus additional gains as you keep going year on year. But imagine you have an asset that's falling in value. So you chuck in the gain in there, but because the asset's depreciating in value, of course that gain will disappear or it'll wither through usage. And so the argument is that for depreciating assets, we do not deduct the gain from the cost of the new depreciating asset. So we freeze the gain and just hold it. Freeze the gain, right? Because we don't want to lose the gain. HMRC don't want to lose their gain. They want that money. They want that gain. They want that gain. They want a tax on that gain. So so what's the theory here? So for depreciating assets, fixed plant and machinery, the benchmark is if it has an expected life of 60 years, do not roll over into it. The gain is not deducted from the cost; it's just frozen. And when but we don't have to pay anything. We just hold it until we actually dispose of the depreciating assets, and disposal or 10 years after the acquisition, if you like. So basically, within 10 years, then that gain will crystallize at some point. So it's still a bit of a holdover. It's a bit of a holdover relief. I almost prefer calling it like that, a holdover relief, as opposed to a rollover relief. So just holding it until for the next 10 years. So let's see what I mean by this. So Zamir buys a freehold factory on the 28th of August 1988, and he sells it for 1.2 million, realizing a chargeable gain of 585,000. So that's the gain. Now he goes along and he buys a fixed plant and machinery. So as soon as you see this, you're thinking, right, okay, here we are. Remember that the same treatment occurs typically. In this case, we expect, if you like, the capital allowances to work through this thing. It's going to fall in value. We take out capital allowances. So it's really rare that you're ever going to be, like I said, we remember a couple of videos ago, that you're selling the fixed plant machinery for more than the actual cost. Most of the time you're selling it for less. This is quite normal, but all of this is worked through the capital allowances anyway. So we don't really start recording a loss. No, this is capitalized. So this is working its way through. The only time we have issues here is when we're selling it for more, if you like. Right. So on the 1st of November, he buys fixed plant machinery. So 1st of November, he buys this fixed plant machinery, and he says that he sells a thing on the 2nd of February 2019. So really, the gain realizes. I mean, first of all, we know that he spent all the money because he sold it for this. That's the proceeds, but he spent all of it. So all of it can be held over. That makes any sense. You can hold over that relief. That can be deferred. And so the question here is that it is frozen until, from 1st of November 2006, it is frozen up till the earliest of when he sells the thing, which is the 2nd of Feb 2019, or 10 years from the acquisition. So 10 years max. So 1st of November 2016. And we can see this is much earlier. So on the 1st of November 2016, this becomes chargeable. This 585 wakes up and crystallizes, if you like. And that's it. We just, wherever it's just chargeable at that date. Nothing will happen here because, like I say, with plant and machinery, remember we argued that normally it's sold for less, and that works its way through the capital allowances when we're dealing with trading income, trading losses. And unless we sold it for more, we would have the issue. But that is unusual. That is unusual. Right, that's example 9. That might be the last bit before we talk about gift relief. I think, yes, it is. So what we'll do is we'll end that video there, and then we will start talking about gift relief in the next video.